Hi there everyone, good morning and welcome to this edition of The Market. I'm Avan Dabash, with me Nikunj Dalmia as well as Anisha Jain, and I can officially call it a good morning purely based on the fact that we hope to piggyback on the kind of cues that we witnessed on Wall Street overnight. You did have the Dow Jones that had its best day since the 13th of Feb. It closed higher by about 340 points. The S&P 500 as well rose by about 0.7%. The Nasdaq as well gained traction. And you did have the major averages which are on their way for a pretty positive close for the week gone by. That's our markets, how we shaped up in yesterday's trading day. You had the weekly expiry and it was lackluster at best as we started off pretty steady but then went on to wrap up around the 17,300 mark, lower by 0.7%. So that's really the lineup for today. We're bracing ourselves, Nikunj, for a good Friday. The SGX Nifty as well is indicating at a positive open. And Wall Street is gaining.
You're sounding very chirpy today. Am I missing on something?
It's Friday. That's the only reason.
No, it could be a good or a decent Friday. And I'm hoping it could be a good and a decent Friday because Wall Street handover is decent. There is a bit of a relief because Nifty has managed to find support from key levels. A lot of market men are now started hunting for value once again. When I have conversations with them, the technical setup is indicating that there could be a bounce for the market looking at the setup we are in. So I don't think we've turned the tide per se, but the block deal in Adani Group of stocks, where the dollar index positioning is, how at lower level there are now more buyers and less sellers. If I string everything together, I'm hoping that we could be in for a day of strength, stroke bounce, rather than a day of numbness, range-bound movement and sideways action. It's only purely based on data and what we have in terms of the market technical setup. I'm hoping that we could be in for a good, stroke decent and a okay Friday.
I'm happy to be proven wrong with respect to my color choice today because we've seen a lot of red off late. So happy to see some green on the screen. And that's likely to happen, Nikunj, right? And the thing that you pointed out about the Adani Group of stocks, wherein there was that block deal that happened worth around 15,500 crores. A very strong hand has now come into the names like Adani Ports, Green Enterprises, Transmission, etc. What's your take of what will this mean for Adani Group of companies? Have they turned the tide, you believe?
I mean, the chatter in the newsroom, Ajay had it that look, a large investor has checked in, and indeed a large investor has checked in. So let's first introduce the investor. Sure. Who is this fund? It's a marquee fund run by Rajiv Jain. He's an old India hand. In his previous avatar, he was managing money for Wantable, and that time also understanding and his faith in India, I think, was absolutely remarkable. So there is an old India hand which has checked into Adani Group of stocks, and it's a sizable commitment of 15,000 crore by a single fund into a group where normally global institutional investors have really shied away. So in the glory days also, you did not have such large marquee funds into the Adani Group of stocks. And here's a guy who comes in and checks in 15,000 crore, one single shot in 4 or 5 Adani Group of companies. That is just some kind of an endorsement coming from a very smart marquee fund manager that he is truly finding value or feels that the worst is behind. I was reading his comments earlier on various other publications, and that time his view was that the Adani Group of companies have a lot of debt, and that was the reason why he did not participate in them. But I guess there is value which clearly seems to be there. So I think in terms of the profile of the investor who's checked in and the name who's checked in and the kind of commitment what we have, I mean, we've had several interactions with him on ET now in his previous avatar. So you pretty much know that his understanding of India is very deep. And there's something I learned from Rajiv a couple of years ago. He said, I never waste a crisis. So is this the crisis where he is not wasting it in buying into Adani Group of stocks? So that's part A of the story. Let's discuss part B now.
Yeah. No, but part A, just wanted to understand a bit more about his psyche. Is he one of those players who enters just because he's seeing that there's a lot of risk-reward play? Or is he the person who looks at deep fundamentals as well and does a bit of long-term research?
No, it's long-term. I don't think what I've seen him manage Wantable and his current fund right now in his new avatar, the holdings pretty much reflect that it's not a, you're always looking for value. You're always looking for risk reward ratio, but it's not like he's buying stocks for years and for quarters, not for months and not for days and months. That's one. Now, part B of the story, I think, is the understanding one, is the important one. What it means for Adani Group of stocks, what it means for Adani Group, and what it means for markets. The money in this case, I'm just going to break it for our viewers, it comes at the promoter level. So 15,000 crore plus suddenly comes into the promoter kitty. Now, if the promoter has got 15,000 crore, what it will do? Well, obviously, you would like to repay your personal debt obligations. That could be loans against shares, or where you've raised capital, or where you've raised debt. That's at the personal balance sheet. B, that also means that from a market standpoint, not that there was a default risk in any of the Adani Group of stocks in terms of the debt repayment. They have really paid their debt. That fear, in a sense, now gets arrested because promoters are flushed with cash. Third, from a sentimental rub-off standpoint, when the Adani saga broke out, lenders, they suffered. Now, this also is going to be having a rub-off effect on the lenders, and especially PSU banks, which have a large exposure to Adani Group of companies. Bear in mind, the money does not come, Anisha and Avan, into the balance sheet of the companies. This is coming at a promoter level. So this is not like Adani FPO, where the money would have come into Adani Enterprises. The money in this case is clearly coming at promoter level, where they would be able to repay their debt obligations. Look, the money will come back into the system. How? And how it would be done, we don't know. We've not got a comment from Adani Group right now. So I'm assuming that this is going to be a relief. B, this is going to calm a lot of nerves, and hopefully we will see stability in Adani Group of stocks now.
Yeah, this is the big news that we're tracking, and Rajiv Jain as well saying that he's excited now to have initiated these positions in the Adani Group of companies. Let's get a move on then and hear it out from Sunil Singhania. He spoke about the recent market volatility, saying that with time, the markets will forget the downtrend and even the move on the downside.
I don't know whether this is the end of the news flow, but I would say that, markets over a period of time, as has been the history and I would say experience earlier, tends to, make it less and less relevant as we move forward. So maybe, it was very relevant towards the end of January. It is relevant maybe today, but not to the same extent it was January. But I think with time, markets will forget and move. We are value conscious investors, and we don't invest in companies which don't have profits or don't have visible profits. And I think most of them still don't have visible profits. Obviously, there are a couple who are on the fringe of seeing profits. And I would say that as the markets get more and more comfortable on their road to profitability and self-sustenance, then more and more investors will look at it.
Right. Let's throw it open to our technical experts. Are we in for a good Friday, or are we in for a sloppy Friday? Kunal has been insisting that the risk-reward ratio has been slightly favorable, and for a change today, Nuresh has decided that he will start, and he will start with a smile on his face. Right, Nuresh?
Good morning.
Right. So why don't you start today with a smile on your face and with a view on Nifty that today bulls will have a good day? You are looking really serious, Sada. I'll start with you.
All right. So
why were you serious first? Tell me. And then we will talk Nifty.
I've slept a little less yesterday.
Okay, chalo. Now let's start Nifty.
So on Nifty, like I had a view yesterday, was buy on dips and maintain that stance. We saw more than I expected a 80-pointer dip. We got a 130-pointer dip. So an entry is done. And now it's a hold, and we are holding on to that 17,300 mark. Expecting a move towards 17,600 and then 17,900. So overall, the first target for this move should be 17,600 is what I go with. And the fact yesterday, which was interesting, is that the broader indices, the mid cap and the small cap indices, did not see a cut. So that was an indication of strength in the broader markets, although the Nifty was struggling. So overall, the view is we go towards 17,600, 900. In the index yesterday, it was all about Reliance and HDFC Bank not doing well. A little bounce back there, and we are quickly at 17,600, 900.
I'm hoping you've slept well, your mood is good, basis what we're seeing from the cues that we're getting overnight. And big smile today, or?
Yeah, I didn't track the US markets yesterday. I just
You
saw
have
the
long
data in the morning.
positions, no wonder.
Yeah, absolutely, yes.
Yeah, no wonder. Okay, now.
So what's the data in the morning?
No, I think this could be a very good comeback. So if we actually open up with 100, 120 points on the SGX Nifty, and assuming in the second half, if we manage to gain from those levels, say even another 40, 50 points, say at 130, 150 points on the Nifty, that could be a very strong comeback for bulls, because I say that over the last 4 days, the Nifty has been an underperforming benchmark index as compared to the other constituents like the Bank Nifty, etc., which have done reasonably well. Now, if today's candlestick pattern and if we cross back about that 17,450, 430 mark on the spot Nifty, we could be coming back towards a breakout on the short-term charts, and that could be a strong indicator that a major bottom or a near-term bottom has been in place or set at that 17,300 odd level. So, would be looking out for the markets today, specifically in the second half. We managed to close about that 17,430, 450 mark. That could be a strong indication that bulls are making a comeback.
Bulls are making a comeback. Now 100 points higher for the Nifty, folks. Are we in for a good bounce, or it could be one of those days where we start up and then we go down? Analyze the Adani news for us, for traders. I mean, it's going to be a gap up for those stocks sentimentally. The charts, what we discussed yesterday, they were indicating that the stocks were not good in terms of the technical setup. Would this block deal force you to change your view?
So I think specifically for two names, that's Adani Enterprise and Adani Ports, this could be a big relief, for those set of stocks. I'm not sure for the rest of the Adani pack, because they are not in FNO, so I don't track them. That
Ambuja is.
Yeah, Ambuja, ACC, they are, of course. So, but ACC and Ambuja Cement, these are very traditionally low beta stocks. So they've fallen less. They would probably rally a bit more less as compared to the other two names. So I would particularly be looking out for Adani Enterprise and Adani Ports, and I think that's where there could be a bigger turnaround as compared to the other FNO stocks.
All right, let's find out individual strategies in terms of top recommendations from our chartists. So, Naresh, what is it that you're tilting towards this morning?
So, buy on Coal India and a buy on SBI. So, first is a buy on Coal India. The stock has given a triangle breakout on the dividend adjusted charts. The stock looks set up for a quick move towards 235. So, expecting the target in the extreme short term. A stop loss at 218. Second is a buy on State Bank of India. The stock has made a base around 480, 500. On hourly charts, it's very close to a breakout above that 535, 538 mark. If that happens, we see a quick move towards 570. So again, trade with a very short-term use. Stop loss at 525.
So those are the top recommendations coming in from Naresh. He likes Coal India, no surprise there, and SBI also makes it to his list. Kunal, what about you? What are you spotting this morning? Some fresh trades?
So fresh trades. First one is about Indian Bank from the PSU names. It looks very attractive on the charts because it's completed a major retracement for itself from those 300 odd levels where the stock tested, and apparently it's been a stock which has corrected significantly less as compared to the other PSU banking stocks, which have corrected 30-40% in the last 2 to 3 months. So that's a stock which I would recommend to buy. Targets of 288, stop loss to be kept at 268, and Voltas comes back into the list because the stock has given a confirmation of a breakout back above the 200-day moving average, and this could be a decisive breakout for trend for Voltas. After a mild consolidation, this could be an indication that a new trend would be beginning for the stock. So buy, targets of 946, stop loss at 900.
Okay, time now to slip into a very short break, but as we do that, listen in to the opinion coming in from Saurabh Mukherjee of Marcellus Investment Managers. He has one of his largest holdings in the IT sector, and he specifically likes TCS and Infosys.
In our consistent compounders portfolio, we hold TCS as one of our largest holdings. I am an investor in consistent compounders, so are my parents and our 10,000 clients. In some of our advisory portfolios, we've also had Infosys for the last 6 months. We're very happy with both those positions. In our mid-cap portfolio, which is Rising Giants, we have LTTS, and as you rightly said, we recently added Tata LFC. These are plays on engineering R&D. As the West reindustrializes, and it's very, very clear the hostility between the West and China is leading to a concerted move to reindustrialize the West, reshoring of auto manufacturing, Significant amount of chip manufacturing also, I think, will move out to China. We've kept discussing on your channel, API manufacturing will move out of China, partly to India, some of it to America. As the West reindustrializes, engineering R&D companies like LTTS, Tata Elxsi, we think will give us a straightforward ability to benefit from that. Both are proven players. Both have shown over the last 6 years steady growth in their top line, bottom line, 20-25% consistent growth in the business. The ongoing digitization of the world and the reindustrialization of the West, I think, are very exciting prospects for us as a country and for these two companies, LTTS and Tata Elxsi. More engineering R&D, these two are. This is less IT, more engineering. We're not big fans of mid-cap IT services stocks. We've always had a bit of a concern that mid-cap IT services stocks are more fragile than they look otherwise.
Welcome back. You've got a healthy handover coming in from Wall Street. That's the SGX Nifty indicating a positive start, up by about 0.5%. But let's put the spotlight on the Adani Group of stocks. They're in focus as the US-based investment firm GQG Partners has bought 15,000 crores worth of stake in 3 Adani Group companies by block deals. Let's understand a little bit more about GQG Partners, what's their street cred, and we've got Sharad joining in with all those details. Morning, Sharad.
Well, yes, the GQG Partners is in focus. They're handling almost $92 billion in terms of assets under management. But the question is, where is the domestic and global exposure coming in? And of course, globally, if we see over here, US is having almost 49% of their portfolios going ahead. But the most important thing and the major chunk apart from US comes to India. That's almost 11.6% of the country-wise investment in the portfolio being seen. Now, apart from this, the country-wise investment portfolio, which we have pointed out, we are also having the major holdings, which are the global holdings which the GQG Partners is having stake in. And of course, big names are coming in, such as Schwab, ExxonMobil, Walmart, and Coca-Cola. Now, apart from the global players itself, the domestic players will also be in focus as they have exposure in ITC, Tata Steel, Power Grid, and stocks such as ICICI Bank and SBI as well. Now, apart from the holdings, actually, let's go into much more details about Indian origin Rajiv Jain, who's at the helm, at the top of the affairs of GQG Partners, and of course he is the former CIO of Wantable Asset Management as well, and he is actually became the CIO of it in the year 2002, and then in 2016 he actually became the founder for GQG Partners, and in the year 2021 one of the largest listings were recorded in Australia in the markets of almost, you can say, $893 million, and that was the listing for GQG Partners. And of course, he is known in the market to actually plunge down huge sums of money on single stocks and also build on bigger positions. Now, apart from this, the street cred, we are expecting that the fund, which is being overall managed in the year 2022, they have gotten almost $8 billion of fresh investment. And in this year itself, 3 out of 4 funds have actually outperformed the benchmark indices. And also in the beginning of the year, or at least in the start of 2022, the fund started investing in the Russian markets as well. So a lot of global actions and global positions coming in from GQG Partners as well. But let's look at how the funds have performed. That's the true barometer. And over here, if we see over almost the annualized return, if we take from the December 2016 as well, their fund, which is their Goldman Sachs Partners International Opportunities Fund, it has given you a return of almost 10.8%. Now we compare it with benchmark indices, that the average of international funds that comes in at almost 8%, while the MSCI World Index without US markets that came in at as low as 4%. So a strong outperformance being seen by the funds managed by the GQG Partners as well. So that is something which we'll be watching out for.
Thank you, Sharad, for putting that into perspective. So a marquee name checking into the Adani Group of stocks, and that definitely would have a sentimental uptick on the stocks today. But it was also HDFC Life which was in focus because the management has met a few analysts, and the commentary seems to be at least on the positive side. Harsh is joining us to tell us what's the latest. Harsh, what is the company saying with respect to their outlook, and any comment regarding the announcement that was made in the budget?
Well, yes, in fact, HDFC Life has been in focus largely on the back of the budget. The stock was trading between 580 and 600. Prior to that, it's fallen down to $480 a share. So management commentary is very, very welcome. I feel what they are suggesting is HDFC Life has all the building blocks in place to offset any impact of the budget proposals that have come through. They're also suggesting that they're looking at new products, product innovation at the higher end of the ticket size. They're designing new products to circumvent some of those budget proposals. What they're suggesting is that death benefits, which are not taxable, will get a higher quantum of benefit, or on the death of the individual, they will get a higher amount of that benefit. Quickly moving on, the management believes that the product could be suitable for HNIs who are looking to pass on benefits to the next generation. They are in discussions with HDFC Bank as well to increase the pie or the share to 70% from the current 60% in the next year and a half. That should also give a fillip to the numbers of HDFC Life, and they are suggesting that they are aiming to increase their margins going forward. So FY23 for them is going to be margin normalization year. FY24 they believe is going to be a margin increase year, but on top of that, what they're also suggesting is they're going to continue to focus on growth. So growth will be the number one priority. The second priority will be margins, and they will look to expand margins is what they're suggesting.
Okay, thanks very much. Those are the latest highlights from HDFC Life. Moving right on then, Ramdev Agarwal, the chairman and co-founder Motilal Oswal Financial Services, says that some of the new age tech companies will make it big in the future. In fact, he says that some of the class of 21 companies could be very successful in the long run. Listen in.
Called class of 21 companies which went public between 2021 and 2022.
Some of them will definitely make it.
You think some of them could make it big?
Sure, because that hype is busted now. There's no more hype. Last year, we were in November, December last year, there were a lot of hype, crazy kind of valuation. And so those things are gone. 60-70% correction has happened now. Can it correct another 23%? That you cannot take it away. But now the promoters have also come to the senses. They also want to make profit. They want to make profit very quickly. And in any case, they want to make large profits. So some of them will be very successful. And some of the companies are very unique. I mean, there are no Me Too companies in that particular segment. So I think if there is a profit pool, if the consumer behavior has changed in some of the companies, clearly digital empowered companies are the companies where you can see few 1 lakh crore, 5 lakh crores companies coming in very quickly. I mean, if at all it has to happen, it will happen very fast. Otherwise, they'll just fall by the wayside.
Why is that startup founders have this maverick image?
Startup founders very often tend to be young. They don't wear suits and ties to office. Do you possess a suit and tie?
No, I don't.
You don't have a suit and a tie?
And I think given the recent news, there are so many large companies which have been taking maverick type calls, right? So it's not necessarily up to us. So it's just a young versus old image, I don't know.
So look, when you don't conform stereotypes that society has in the past expected from people in business, you're called a maverick.
It gives me great pleasure to bring on board Nishit Daya, the co-founder of PB Fintech or Policy Bazaar. The last reported data, and if I take the ESOP charges away, you're actually making money, which means there's no cash involved. And you've given a guidance that you will be positive, which is profitable, in FY24. Define that for us.
We are a seasonal business, so you have some seasonality, etc. When we finish March 24, overall for that thing, we would be PAT positive, is my estimate. If anybody noticed, last quarter we did make 87 crore loss, but our ESOP charges were 111 crores. Yes, you're seeing losses, but those losses are ESOP charges.
All right, let's get a move on then, and here are some top fundamental stock ideas as well. Chakri Lokpriya, what is he betting on? Let's find out.
I think, in addition to Voltas, we would also buy a Crompton Consumer. The stock has corrected significantly, and it has had its fair share of problems, and they'll also benefit from some kind of consumer spend. Symphony is another stock which traditionally does well in any summer, and of course, while it is not really a summer issue, but I think some of these companies like Thomas Cook and Mahindra Holidays will benefit from the summer travel. So I think basically it is Voltas, Symphony, Crompton Consumer, and the hotel companies.
Okay, so the summer theme is something that Chakri is proposing, but we had a word with the management at Orient Electric yesterday and didn't sound too confident, at least for now, as far as demand is concerned. So we'll see how that plays out. But let's talk about some of the stocks that are expected to buzz around in the news today. We looked at HDFC Life, where in the management commentary, something is which is quite optimistic, and M&M Financial will be in focus because they reported their provisional numbers for the month gone by, and again a good growth coming in on a year-on-year basis, plus 50% growth on a year-on-year basis with respect to disbursements. So on quarter-on-quarter, it was a single-digit growth that came by. Kunal, if you had to look at the charts of HDFC Life and M&M Financial, what would you recommend?
So M&M Financial, of course, is the stock which I would recommend. HDFC Life is still not been able to find its feet after that sharp correction, post the budget, when the stock fell from, I think, 620, 618 to sub 500 mark for itself. There was a mild bounce for HDFC Life, but then that bounce has also gotten sold off and the stock has come back into retesting the previous lows of sub 500. So this correction is not settling into the stock price, and which could probably be a point of concern for the stock price. And this is the case with most of the other insurance stocks like SBI Life, HDFC Life, etc. Most of these insurance stocks are forming a very similar pattern of double testing their previous lows, and till the time we don't see evidence that these stocks have been settling into a trading range as well as going through a phase of consolidation, this volatility would continue, and that may not be a good sign for a trend to stabilize as well as emerge. But on the other hand, I think the other names which you mentioned, I think those are the kind of stocks which M&M Finance, for example, that's a stock which has been looking very sturdy and strong. It's been holding its bigger breakout point, which is around 225 mark for itself. It's been comfortably above the 200-day moving average. Yes, the last few days the stock has come back towards its 50 DMA, but largely the trend is very, very strong and stable.
Okay, so the trend is stable as far as some of these stocks are concerned. But Naresh, also wanted your sense regarding the Nifty Metal Index and the pack as a whole, because today, of course, there's a positive news that the Indian steel mills have increased their HRC and CRC prices by 1,000 to 2,000 rupees, and now the price stands at close to 61 to 61,500. So there seems to be a bit of a demand revival, and that's why the companies have been able to take some price hikes as well. What would be your top bet when it comes to the metal stocks?
So in terms of metals, clearly two stocks which have done relatively better is Jindal Steel and JSW Steel. Jindal Steel in the last cycle in 2022 it topped out around 570, 580 levels. Today also it is at the same prices. The recent 52-week high and an all-time high is at closer to 620 mark. So the stock is not even down 10% from an all-time high, whereas the rest of the names like Steel Authority of India Limited or a Tata Steel have corrected sharply. So Jindal Steel is one. Second is JSW Steel, which again has a very similar formation. The stock has not given a terrible return over the last 1.5 years, even when the stock topped out way back in April 21. So these are the two names. They've seen a decent correction of 10% in the near term, but relative outperformance is better. So for the say near term, I would expect Jindal Steel and JSW Steel to do better.
Been for a good Friday today. While global handover is decent, 15,000 crore has come into the promoter kitty for Adani Group of companies, and the Fed now seems to be, there is a new, the Atlanta governor, or Atlanta US Fed governor, feels that 25 bips is what the US economy can digest. Anything more than that is going to have an impact in terms of the economic growth of the US economy. Sandeep Sabharwal is ready. Let's connect with him. Let's say hello to him. Sandeep, good morning. Thank you for joining us. Analyze the Adani news for our viewers. What it means for Adani stocks, what it means for the markets.
So when the Adani FPO was on, it was unclear who are the investors going to be, etc. And to that extent, people were not sure of where the money is coming from. This fundraising seems to be more credible in the sense that it's to a large established foreign investor with good credentials. So I think that will give some confidence to the markets and reduce risk to the group in the near term. So I think, and to that extent, that's also positive for overall market stability. But going forward, we have this C-appointed committee, SEBI investigations, etc., which will take around 2 months. So I think till that point of time, uncertainties will remain. But its impact on the overall market will now recede. And to that extent, it's positive for the markets as a whole.
So positive news coming in, definitely a sentiment bump up is what we can expect on some of these Adani Group of companies, and as you pointed out, good news for the full market as well. But Sandeep, yesterday one of the stocks that was in the spotlight was Macrotech Developers. It surged as much as 20%. What's your take on the company and the sector as a whole?
The single day moves are very tough to explain, and the reasons I don't really know why it moved up so much. So, but overall, for the real estate sector, rising interest rates tend to be not positive, and the stock prices of real estate companies are most sensitive to interest rate movements. So, I would still think that there could be some time before we should be looking at the real estate sector as a whole. For macro tech, I don't have a specific view.
Okay, so some more time before one should look at the real estate sector. But is this a similar view that you'll have for two-wheelers as well? Any big takeaways as far as the monthly auto sales data is concerned, Sandeep?
So four-wheeler sales continue to be strong, and yes, so I think there's been some sell-off in stocks because of some predictions of El Nino, etc., which I think is too premature, and the impact of that actually will still need to be seen. Overall, consumer demand for four-wheeler on the consumer side still continues to be strong. So I think those companies still are well placed. Two-wheeler revival is still stalled, although companies from the two-wheeler segment have been talking bullish, but the numbers don't add up. So I would think that they should present some opportunity for buying, but I think it will be prior to the next festival season, which will like the October festival season. So I think around that time we should see some bottoming on these stocks.
Okay, let's find out then which are the stocks on the editor's radar. We'll get an analysis and understand the news behind it. Let's begin then in the cement space with Ultratech Cement. It's actually Ultratech and Shree Cement that are in the spotlight. They're on Citi's radar. They've got a report that's come out on both of the counters where they say they're overweight on Ultratech Cement and underweight on Shree Cement. Talking about the overall valuations, the recent price hikes that have taken place, what's the outlook on Ultratech?
My personal view is that when Adani Group acquired ACC and Ambuja, everyone thought that this is going to be the large disruptor, and they would be looking at really scaling up the capacity. And after a telecom war, could there be a cement war? That was the fear, and some of these stocks, in a sense, lost their mojo. Looking at the current setup and the state of affairs, one would imagine that Adani Group has no option but to go easy on the expansion plan for all the group companies. That means that the existing players who've got capacity and who are expanding right now, in a sense, would be disproportionate beneficiaries. There's a big difference in Shree Cement and Ultratech Cement. So Citi is talking about it as a theme, but Shree Cement is efficiency, Ultratech is size. I think with cement right now, it's about size because the economy is on a kind of an upturn. Shree Cement is expensive, Ultratech is not very cheap, but some would argue that it has got contours which would benefit given what's happened with the Adani Group, and B, the positioning of the business per se is so strong that if there is a little bit of pricing power which starts coming back, as the base effect would kick in, coal effect, coal prices will start coming down, the natural health of the economy will start healing, the government capex will pick up because this quarter is supposed to be a good quarter for them. You may make a case for Ultratech Cement to outperform, and Shree Cement in a sense is like one of those stocks you want to say, look, am I ready to pay a premium for good quality, efficient management? Then I think it is Shree Cement.
Okay, there you have it. That's how the two companies are very different when it comes to the cement space and what the news for Adani as well means for them. Trent, then, this is pretty interesting. Motilal Oswal interacted and they basically came back with a takeaway that the consumer discretionary spend is looking a little bit weak. They have delivered a better price performance, largely on account of the price hikes, but they continue to remain fairly bullish on the company, and they're talking about Star as well, all starting to add to the operational efficiency.
Okay, so I'll take a pause and let's compare Aditya Birla Fashion Retail and Trent. 1 year, 2 year, 3 year. One is a Tata Group company, other is a Birla Group company. But in terms of the stock performance and what they've delivered, I think Trent has really managed to hit out of the park. At the same time, if you look at Aditya Birla ABFRL in 52-week down 10%, Trent is up 17%. There's a big difference. They both are in fashion retail. The difference is that Trent has done a great job of managing the balance sheet. Westside is doing well. Zudio is doing very well. While there is a bit of a slowdown, which I think is there in the discretionary end of the market, and I think that is visible in not just apparel as a category, I guess all the other categories. I guess for Trent or a company like Trent, this could really be temporary. What is important is they're focusing on, very focused, unlike other fashion brands who acquired one fashion designer, one non-core business, Trent has been very, very focused. Yeah. The balance sheet is solid, they're expanding, and they are now increasing the complexity of the businesses by going national, by going all India. So I guess in my book, Trent is a stock you should buy on a decline, because when you see good businesses, when they go through temporary slowdown, and when there is a yes and I don't know happening in the market, that's the time you get these businesses.
Yep. So a thumbs up coming in on Trent, and the returns really proof in the pudding as to how they've performed, Anisha. So those are the stocks on the editor's radar.
Okay, so those are the stocks on editor's radar, Trent as well as Ultratech Cement. But let's get you some fundamental ideas as well. Listen in to what Pankaj Pandey, the head of research at ICICIdirect.com, is betting on.
From a sectoral perspective, I think we have started liking some of the PSUs, say for example NTPC or something like say ONGC. Besides that, I think our sense is that banking has been sort of struggling for some time, but given the fact that IT overall, since the US Fed is still hawkish, probably the kind of run-up what we have seen in the 5-6 probably 1.5 months in IT probably might take a pause, and banks ideally should sort of do better from that perspective. And you've seen banks sort of doing well, especially on the unsecured side of the portfolio. Most of the banks have been sort of inching up that portfolio. So NIM expansion can still sort of pan out in the next quarter. And valuation look reasonable to us. So we like something like HDFC Bank or Federal Bank. And then I think in some of the mid caps, say for example, Techno Electric is one company which missed out in terms of numbers, largely on the execution side. But our sense is that Q4 ideally should be a lot more better than what we have seen. We like some of the other names like Action Construction Equipment, largely from a overall capital goods perspective. And then within software, we like small cap companies like say Newgen Software, where the management is quite confident of delivering good double-digit growth over the next 2-3 years.
Poverty and how the world is prepared, God forbid, in case there is a pandemic coming in the future. Sandeep, let's pick up on Ultratech. When Adani acquired Ambuja, the fear was that there could be a war between two corporates. Now that fear, in a sense, is taking a backseat. Could Ultratech regain its mojo? It lost its sheen because of fear of competition.
It did, Nikunj, but cement as a pack has outperformed the market significantly in the near term. Now the challenge for cement companies is twofold. One, the supply increase over the next 2-3 years is expected to be much stronger than demand increase as the companies vie for market share. And secondly, the price increases as well as the cost reductions have not kept pace with what the managements of most of the companies guided for, and that's why we've seen some disappointment in earnings. So I would think that although demand scenario looks reasonably encouraging, given all these factors, the valuation argument for most cement companies is not very encouraging at this stage. So I don't think they'll fall too much, but I don't think they should rise too much in the near term.
Okay. But Sandeep, just to have a counter argument, we are soon moving into a new election cycle. The government capital expenditure commitment is strong. One would argue and say that, look, there is going to be rural spend, there is going to be spend coming from government infrastructure, and the cement demand in general could do well.
No, that's true. So I never said that demand will not be good. What I said was that in a commodity industry, it's all about demand and supply. How does that match up? So the supply increases are going to be very rapid over the next 2 years. And that will keep a lid on the overall pricing. For example, in the last 4-5 months also, the expectation of price hikes were much greater than what actually has happened. So very minuscule price hikes have been actually delivered in peak construction time, which is on right now. So that will present a challenge to earnings delivery versus earning expectations. So I think that's something we need to watch out for.
Okay, so that's the take coming in as far as cement demand is concerned. So that's likely to, be robust, but it's just the commoditized version of the business that you need to watch out for. Kunal, wanted your take regarding a couple of these companies. GAIL is going to be in focus today because it seems that there are reports doing round that PNGRB has proposed a hike in tariffs for pipeline by 41%, and that could imply a 25% increase for the EPS estimates for the next year, etc. as well. You have been quite positive on the oil and gas space, and so has Naresh been. Do you see further upside on a stock like GAIL?
Yeah, I think there should be further upside. In fact, the last week up move or the move which started off from this week, in the beginning when stock was I think at 1992 levels to 100, 102, 104 I think was the high the stock had made 2 or 3 days back. That was a very strong move, and this is a bit uncanny to the behavior of GAIL typically because it's a stock which is very very low beta, extremely sideways. To get a 10% move at times a trader has to wait for maybe 2 to 3 months. Now if you get that going for a stock like GAIL in a matter of just about 2 or 3 trading sessions, that tells you that there's been a dramatic change to the behavior of the stock, and that generally leads to a change of trend. So now this 100 odd mark, which was the breakout point for GAIL, that has been acting as a support. So even after the last 2 days of mild correction for the stock price or a mean reversion, the stock has been unable to go below that 100 mark, which means that buyers are staying intact in the stock price, as well as possibly of a breakout on the upside is pretty much high. My sense is that this 10 rupee up move should get replicated on the upside. 114 approximately could be a target for GAIL.
All right, that's the view coming in on some of the movers and shakers in trade. But let's get a move on then. And Alembic Pharma will be taking an impairment charge of close to 1,100 odd crores. This is on 3 manufacturing plants that are under construction in Gujarat. Let's take it across to Somit. He joins in with all the details. Somit, what are the implications of this?
Well, in an announcement, the company said that they will be writing off assets or capital work in progress worth nearly 1,150 crore rupees. Now, this is related to recently commissioned or to be commissioned facilities. Now, the company is doing so because they believe that the recoverable value of these assets has significantly reduced due to adverse market condition. Now, as of September 2022, if you see the total capital work in progress in the company's books stood at close to 2,400 crore rupees, and nearly half of it has been written off by the company. Now, this is related to 3 facilities which are in oncology, injectables, oral solids, and ophthalmic and generic injectables. Now, though the company has recently started getting product approvals from US FDA for the injectable facility, the company believes that they might not be able to recover that much value from these assets as much as they have invested. In short, they are saying that the investments that they have done in these assets in the past will not be able to recover, and hence they are writing off these investments from their book. Now, do remember this impairment won't lead to any cash outflow as it will be done from the general reserves of the company, but it is kind of negative because these investments have been done by the company and cash has been deployed by the company in the past. Now, originally company had planned a 2,000 crore rupees capex to set up 3 new facilities during FY18 to FY20, which got delayed due to COVID, and because of this the market conditions also deteriorated. Now, because of COVID also, if you see the capital expenditure of the company overshooted, and the total capex stood at close to 3,500 crore rupees. Now, majority of this capex was shown as CWIP because the commissioning of these plans was still pending, and earlier also in FY22 and in the 9 months of FY23 the company has impaired or written off R&D expenses worth nearly 200 to 150 crore rupees, and so far in 9 months FY23 if you see the company's net profit were down by nearly 61% on a YOY basis because of these write-offs.
Sandeep, where do you think markets right now are still assuming that growth will be strong, these stocks will recover, and we could be in for some disappointment? It could be time-wise correction, price-wise correction, earning disappointment.
In some specific stocks, you're saying?
I mean, theme-specific stocks. For example, let's say we had this debate exactly a year ago that IT was expensive. That time everybody was in a denial mode. But look at what has, emerged. Where do you think that kind of an optimism is still reigning supreme?
So I would think that there was some optimism in the banking side, which was excessive, which also got taken out. So I don't see very huge pockets of excessive optimism right now. Like as large theme-based pocket. So I don't really see that right now.
Which is on your radar, which you want to buy or looking at buying, you're just waiting for that right entry point?
So the entry points are there right now. So what I'm looking at actually now, after not looking at most of the consumer stocks for a long time, where I thought that the valuations were very, very high. Now I'm actually looking at buying some of the beaten down ones. So so we started accumulating some Bata. So even after that, it's fallen 10%. So I think that stock's down around 40% from the peaks of last year. I think typically 35-40% fall in strong consumer brands is where I start looking at accumulating. So this is one stock which I see having value for someone who's willing to hold for 1 or 2 years.
All right. Meantime, let's also get in a view then, Sandeep, as to where your preference lies within the entire pharma space. Are you looking at a bit of a defensive tilt at the moment, and will you be very selective on stocks within the pharma sector?
Yeah, pharma, we have to be very, very selective because of various factors. One, the pricing pressures in most export markets still continue. China is coming back to normalcy, so I think and those supply chain issues will also go away, which boosted the profits of some of the mid-cap pharma companies in specific segments. So I think that's something people need to be aware of. So even if, so people need to be focused on the larger companies in pharma. And so Cipla has its own issues now, which was a big outperformer. So that just leaves Dr. Reddy's and Sun Pharma. So Sun Pharma is something which we hold, where I think the company has been doing well and continuously outperforming. So that's the only stock I hold, but I think that's the only choice people have: Sun Pharma or Dr. Reddy's.
Limited choice when it comes to the pharma sector, Sun Pharma and Dr. Reddy's for now. But Sandeep, how would you recommend one to play this entire manufacturing theme and industrials? Which are your top bets which you think have not run up and still provide some value?
So manufacturing industrials across the board, I think there is momentum today. So among the construction companies, we hold NCC and Ahluwalia contracts. I think both of these companies' valuations are relatively very cheap vis-a-vis their growth prospects, order book, and the kind of balance sheets they've been able to have, with NCC cutting down debt substantially and Ahluwalia being a debt-free company. So I think that's on the mid-cap side. Obviously, L&T should continue to be a theme which investors should hold in India. On capital goods side also, I think there are various companies which could present opportunities.
Okay. 2 minutes to go, and the first pre-open rates would kick in. Are we in for a decent Friday? I mean, it's just been one of those weeks where markets have struggled to find their rhythm. Let's go back to PSU banks and the large ones, BOB, SBI, Can Bank. All of them have corrected 10% plus. For a sector which was in a crazy frenzy bull market, the reversal is 10 to 15%. And Kunal, all bull markets correct. 10% does not mean the bull market in some of the PSU banks is over. Question number one, is the bull market over? And if the bull market is not over, is it time to buy them then?
Well, the bull market is not definitely not
specifically
over.
for PSU banks.
Definitely not over for the PSU banks. So, one of the metrics is not just 10% or 20% retracement. We look out for is what is the recent rise for these stocks. Now, I'll give an example. I think UCO Bank, for example, the stock was almost at 10.5 or 11 rupees before the start of the previous quarter of very strong uptrend. It went up to as much as 38 rupees, which means the stock went from 11 rupees to 38, more than 2x kind of a return for itself. And from 38, the stock has come back towards a level of 26 or 26.5, the stock closed yesterday. When you look at this in the context that it's just not even a 50% retracement for the stock from the steep rise the stock has seen. Now, that's how you generally gauge that when a stock rallies up, for example, 2x or 200% return, if it corrects by 30-40%, it's still a very mild correction as compared to the steep rise the stock has shown. And those are natural corrections because indicators come back into an overbought territory, so they have to cool off, and the stock goes into a time-wise correction because there is too much of expectation which gets built into the stock price because of the sudden rise. Now, once all of that is digested, which is a process of maybe a couple of quarters, that's where the stock starts to get into a stable uptrend. So I would be of the belief that a major part of the correction for the PSU banking stocks is definitely behind us. These stocks can correct by another 5%, but I think from a pure risk reward play, looking at the recent last 3-month rise for these stocks, I think it's a brilliant risk reward to enter the space.
Sandeep Sarwal, before you log out, let's get this final word from you. Brilliant time, according to Kunal, to buy into PSU banks.
It might be actually, I don't really know, but except for SBI, I don't buy into PSU banks. And that's more due to my view on the overall structural issues related to banking long term.
Fair point. Appreciate your time, Sandeep. Thank you for joining us. First